Hello, everyone. Today on the final bar, we'll do our normal Monday routine. We hit the market from three directions: top-down macro, bottom-up stock picking, sector rotation. We'll hit on all the key charts in each of those three important areas. The S&P major averages really choppy, finishing sort of an unchanged level from where we finished the week last Friday. Defensive feel quite a bit with utilities and real estate in the top three sectors. Ladies and gentlemen, this is the final bar. Hello, everyone. Welcome to the final bar. I'm your host, Dave Keller. I'm the chief market strategist here at StockCharts.com in a very rainy Redmond, Washington. Thanks for joining us every weekday after the close as we focus on the market environment using the language of technical analysis, using the StockCharts platform to better understand market dynamics by analyzing the indicators of price, breadth, sentiment, trend, momentum, all of those different inputs to try to make sense of things. And, today, a bit of a choppy day at the end. The major averages really didn't move a ton. However, there were some movements outside of the S&P 500. If you look at certain sectors, for example, utilities versus healthcare, quite a differentiation between what was working and what was not working. We're talking about the overall trend in stocks, which has been undeniably higher. I was talking with Grayson Rose earlier today here at StockCharts. We were talking about the overall strength of the market environment. Just the average chart looks pretty good. The value line index is making new highs. The Wilshire 5000, which we'll look at a little later today, making new highs recently as well. So overall, the charts are fairly constructive. However, there is quite a differentiation between what's really working, kind of what's sideways, and what's lagging. And this is where stock picking really can come into play. So great time to think about scanning. Think about your chart lists, which we'll talk about here in a moment. So many other good things. We'll get to all of the charts here momentarily. I did want to let you know some of the guests we have coming up this week on the show. On Tuesday, the 16th, we have Jesse Felder from the Felder Report. On Wednesday, the 17th, Javed Mirza from Canaccord Genuity in Toronto. On Thursday, investor, educator, and technical analysis aficionado, Bruce Frazier, who will share with us the Wyckofian perspective about what's going on here. Just as a heads up, we'll be taking a little bit of time off for the Thanksgiving holiday next week. So Wednesday, Thursday, Friday, no new shows, and we'll be back with you the Monday after. Also, to let you know, I mentioned chart lists, and we have a series called Chart School, which we bring up occasionally. All this week at 11 o'clock Eastern, there's a different presenter sharing with you how they use the chart lists feature on StockCharts.com. So Greg Schnell did a presentation earlier today. The rest of this week, every morning, 11 a.m. Eastern, make sure you tune in for it. If you miss them, you can check them out on our YouTube channel or on StockCharts TV on demand. Really well done, and I would encourage you to check those out because chart lists are probably one of the best parts of the StockCharts platform, just to help you make sense of the world around you. Also, I will be doing the next presentation through Market Misbehavior, a free webcast coming up tomorrow on Tuesday, November 16th. That's at 1 o'clock Eastern. It'll be entitled Small Cap Stocks, What, Why, When, and How. We will talk to you about what small caps really represent, what types of names they are, and what sectors you might be exposed to by looking in the small cap space. We'll talk about why this could be an interesting time to gain exposure as the Russell 2000, the S&P 600 just breaking out. Talk about when that tends to work in the seasonal calendar and how you can start to gain exposure to it. We'll talk about some of the different levers you can pull to gain exposure to small caps, including screening for ideas. So to sign up for that free event, go to marketmisbehavior.com/small caps. That'll be next Tuesday, the 16th at 1 o'clock Eastern. Let's continue today's show with our market recaps. We have three parts to the Monday show. We start with the macro, and then we go to the micro. So we'll talk about the big picture, we'll talk about sectors, then we'll talk about individual stocks. And this really mirrors my own process of analyzing the market environment. For me, my weekly process starts every Thursday and goes through Monday, which is kind of strange, but that's just how I've worked it out with this show, with my premium members at Market Misbehavior, is sort of the calendar and how it kind of goes out. And what's important for me and most successful analysts that I've worked with and worked for is having a disciplined daily and weekly routine. And I would encourage you to think about your own as much as you can, for sure. So overall, let's talk about the big picture. The S&P really flat. Let's look at a chart of the S&P 500. We talk about this on most days, but on Friday in particular, we dug into the S&P chart. And I know with my guest on Thursday, Joe Duarte, we talked about the breadth conditions a little more, talked about the advanced decline line making new highs. And as I mentioned, I was talking with Grayson Rose earlier today, and we were just looking at some of the key stocks, some of which I'll share with you here in a little bit. But the chart of the S&P 500 looks largely constructive. And overall, as we've said many times, the most bullish thing the market can do is go up. So, what Grayson and I talked about is you often, it could have been said many times over the last 12 months, the market feels overextended. And I'm sure that phrase has escaped my lips a number of times, probably when we had some of these bearish momentum divergences back in January, back in April, back in July. And these were, the charts were suggesting that we may be seeing momentum dissipating a little bit. Notably, you're seeing that on the chart of Bitcoin right now, actually. We have a bearish momentum divergence, higher highs in price with lower momentum. But none of those really materialized that much in the price of the S&P, drawing down too much, right? At most, you had a 4 to 6% pullback in any of the pullbacks during the course of 2021, nothing more than that. And that's actually pretty unusual. Usually you can expect at least 10+% pullback. We haven't had it in 2021. Now there's plenty of game left. There's 6 weeks or so left in the year. So certainly we could see a deeper drawdown, but I would tell you, if we would have a steep drawdown right now, that would be very unusual when you look at the normal cyclical pattern in stocks. November, December tend to be pretty good. Tend to be pretty strong, particularly you're going into the holiday season. In general, it tends to be pretty strong for stocks. In November through April are the seasonally strongest parts, and most of that is in November and December, then into January. So overall, the S&P is not far off of all-time highs, just above 4,700. Overall, we just pulled back last week, and again, higher highs, higher lows are an uptrend. And if you take a step back from the chart, you can see overall the uptrend is in pretty good shape. We were recently at the most overbought level we've seen in the S&P for quite some time, and so it's reasonable that you would have a bit of a pullback after that overbought condition. But at this point, again, looking at a lot of individual names, I'm still seeing a lot to like in terms of the overall technical configuration. So overall, conditions seem to be still very favorable for the SP. And I should note the market trend model that we talk about every Friday, bullish across the board, long-term, medium-term, short-term as well. Elsewhere, just at the big picture, the VIX is continuing a little bit higher. So while stocks were flat, volatility increased a bit. The range of 15 to 2022 has been sort of the story for the last 6 to 8 months. And overall, we're sort of still well within that range, kind of at the midpoint of that range that we've been in for most of the year. In terms of what movements we saw today outside of just the major indexes that were flat, two to note on the second tab here. First off is interest rates that continue to go higher. Now, I would tell you, when I've been asked about a long-term take on the markets going into next year, the number one thing I think investors will have to deal with, and there are a lot, and I'm things like the coronavirus, obviously very important, geopolitical issues, obviously very important, but I think interest rates and the Fed, that's the number one most important thing in terms of what has the potential to change the trajectory of stocks. And I think what is most likely to change the trajectory of stocks, I think it's going to be how investors process and deal with the Fed and their potential, the game plan that they've now outlined more and more specifically. 10-year yield back above 160. If we look at a chart, $TNX is the main ticker to look at the 10-year yield. You can see we're sort of firmly in that range between 150 and 175. That's where we spent a couple months back here in the spring to early summer. We then went below there and got into the 110-ish area, 115, and then rotated back higher. Now we're once again within this range. I wouldn't be surprised if we spend some time here, which is what's happening. But overall, I would argue that rates certainly are most likely to go higher from here overall. And I don't want to say undeniable, because there's certainly a chance that it wouldn't. But I think it's highly likely that 10-year yields go higher from here. And when you think about what that tends to do, that tends to be a tailwind for certain sectors, more value-oriented sectors, and especially the financial sector tends to be a headwind for some of the more growthy stuff that has been leadership going into this period. So the higher rate environment, I think, is an important one. You saw rates continue to bounce higher today, and the movement over the last week or two has certainly been bouncing off of moving average support and rotating back to the upside. So I think looking at 170 to 175, that's the blue shaded area. That's where we've hit resistance a number of times. That's where I would be looking next. for upside resistance. But overall, I think that's a story to pay close attention to. The dollar index also going higher today, about 0.5%. The UUP doesn't move a ton, to be honest, day to day. I mean, it tends to be a lower volatility sort of asset class, but overall the dollar has been strengthening, and that tends to mean U.S. stocks doing much better than non-U.S. stocks. And overall, that's been the trend that we've seen, but certainly something to pay attention to as well. Finally, commodities essentially flat today. You had oil prices up just a touch, but not much. The commodity index, the DBC, which is the main ETF we refer to, not really doing much relative to other asset classes, and gold really flat. So when you talk about inflation hedges, when we talk about the prospect of higher inflation and hedging against that, gold prices tend to be where people do that. Gold really isn't breaking out a ton yet. It has broken out, but not really falling through to the upside just yet. But that's another chart I would certainly pay attention to. Just to wrap up this macro portion of the show, cryptocurrencies coming off. This is after rallying over a little bit into the early morning hours on Monday, with Bitcoin getting above 66,000 once again, but coming off just below 64,000 right now. And most of the major coins we track, including Ethereum, which has had a pretty good run, all selling off here through the course of the equity trading session here midday Eastern time. Let's continue on with our second segment called Sector Setups. We've talked about the big picture. We've talked about the overall strength in stocks, some of the key themes of some of the other asset classes. And again, I would encourage you to pay close attention to the chart of the 10-year yield. I think that's maybe the most important one to pay attention to for stock picking purposes, thinking about leadership and laggardship through year end and into next year. And let's talk about some of the sector trends that we've seen as well. This is the weekly RRG, and I did a presentation with Julius de Kempener last week, I want to say, for the Money Show. We had a lot of fun doing a presentation together, talking about sector themes and rotations, and digging into one particular sector, the consumer discretionary sector. Now, I need to talk to Julius. Maybe we can recreate that session for StockCharts TV, because it was a lot of fun, and we related the RRG, this visualization, with a lot of the other tools like the scooter rankings and the regular Sharp Charts tools and ACP on the StockCharts platform. But the RRG is meant to illustrate the 11 S&P sectors, how they're rotating around the S&P, which is at the crosshairs in the middle, and up and to the right is improving relative characteristics, and in the leading quadrant, meaning it's in the upper fourth quadrant of the visualization, means it's basically the strongest. And so energy number one, consumer discretionary number two. While technology is not in the leading quadrant, it's rotating back in that direction. And so it's heading northeast, which is the direction you want things to go, which means the relative strength is improving and the momentum is improving as well. So those are the three strongest sectors in terms of where the opportunities have been, and financials would be the fourth one from there. Everything else is sort of in the lower left portion of this visualization. And the ones to avoid using this visualization are really all the defensive stuff. Real estate, staples, utilities, healthcare are kind of all in the lagging quadrant and heading southwest, which is the direction of deterioration. In terms of where some emerging opportunities may be, very interestingly, in two sectors, materials and industrials. These are the other two sectors heading northeast, and they're the only two in the improving quadrant. And in general, the way you think of this are the things in the upper right quadrant, hopefully you own, hopefully you're there and you have exposure. The weakening quadrant is where you think a little more tactically, where you start to lighten up. In general, you lean away from stuff in the lagging quadrant. In the improving quadrant is where you look opportunistically for things starting to rotate higher. So it's very interesting to me that two of these cyclical sectors, materials and industrials, are starting to show strength, because a lot of the really good opportunities that have come up in my own screening outside of the sectors over here, energy, which overall looks fairly constructive, consumer discretionary, we've seen some very good charts, things like auto parts, automakers, Ford and GM strengthening very nicely. Elsewhere, it's in materials and industrials. I was talking earlier with Grayson Rose, as I mentioned, about trucking companies. We're talking about logistics companies. Some of these charts that are really improving to the upside. Building materials is another one, with charts like Masco and Johnson Controls all rotating to the upside very, very nicely. So really good opportunities potentially within those sectors. Let's look at the 11 S&P sectors now using the candle glance function. And again, if you missed Greg Schnell's presentation earlier today, all this week. We have this special series called Chart School, digging into the chart list feature. And I'm sure people will be talking about things like candle glance and other ways you can analyze the members of a chart list once you import or set up those lists. And this is the way I like to look at the 11 S&P sectors and the S&P itself and look at how the charts are all related to one another. So which of these charts, as you're looking at the screen and you see these 11 sectors, which of these stand out to you as different? And I will tell you, as you're looking across these ones, the one that's probably the most notable, because it's the only one that is sort of at or near the or below the 50-day moving average, is communication services. Look at how a lot of these other sectors like consumer staples breaking above the August high, above both moving averages. Financials, while the sector has pulled back a bit overall in an uptrend, making higher highs recently. Energy making highs, industrials, materials, technology, these are all in a position of strength. You compare that to something like communication services, which is clearly lagged behind in the last month or two, and you can see how the relative strength has really taken a dip, really from the beginning of September. This is when the S&P is making a new high. From there, it's coming off. Now, while this is not a horrible chart, and again, if this is what the charts of my holdings look like, I probably wouldn't be that upset about it. I mean, these aren't going down; they're just not going up as much as other things, and that's why the relative strength is going down so much while the price is flat. Just other things are appreciating during these last 8 weeks or so. And this is, if you think about communication services, it's kind of a mishmash. You have things like AT&T, which are pretty rough from a technical perspective. I'm just really deteriorating on a price base. You also have entertainment stocks, which have been struggling quite a bit. Things like Discovery and Viacom and others. But you also have some of the internet names that are holding up very well. Alphabet, for example, right? A good example of a chart in this sector that's continuing to hold its relative position very, very nicely. So in the end, this is netting out to a fairly negative sector, but communication services strikes me as one with a pretty diverse group of names in there. Some very different exposures you could get if you think tactically within there. The two sectors I'll highlight, maybe four of them, sorry. The first two would be industrials and materials. We mentioned on the relative rotation graph how those were rotating higher. And you can see both of these really weren't doing much on an absolute basis for the 6 months going into mid-September. From there, look at how they've rotated higher, both now achieving new all-time highs, both pushing higher. And if you look at the relative strength on either of these, really starting to improve a little bit. And so I think that rotation on industrials and materials, certainly a play on infrastructure spending, on the economy, continuing to improve or strengthen from here, and improvements going into next year. And I think you're seeing that reflected on both of those charts. Finally, some of the defensive areas of the market, utilities and real estate. We don't have time to go in too deeply to them, but REITs not too far off of all-time highs, and utilities with today's rally sort of potentially bouncing out of this congestion pattern that it's been in. I'd keep an eye on both of those sectors going forward. We need to take a quick break. We'll be back with my next segment, Shifting Stocks. We'll see you in a minute. Hey, everyone. Welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. Thanks so much for joining us every weekday after the close as we make sense of these markets together using the power of technical analysis and behavioral finance. A couple quick announcements before we continue today's show with our Shifting Stocks segment. First off, we love to hear your questions. We've gotten so many great questions from you guys over the last couple of years, and we would welcome them very much. We'll do a mailbag segment on tomorrow's show and also at the end of the week, and we would love to answer your question live on the air. Our email is thefinalbar@stockcharts.com. We are on Twitter @FinalBarSCTV. We're on YouTube. Just put a comment below the video you're watching on our Stock Charts channel. We'd love to hear your questions. Hope to answer one of yours in our next mailbag segment on Tuesday of this week. Also, go to stockchartstv.com. Use your email address. You can set up a free account. That is our on-demand platform. Great shows like the Final Bar, Your Daily 5, and other great daily and weekly shows. Special events like The Pitch, our year in review coming up in December, our market outlook coming up in January. Special events like Chart School, all available on demand from our website. Also, on your mobile device, just go to the App Store and search for Stock Charts TV on demand. Our next segment is called Shifting Stocks. We now continue our process macro to micro. We've talked about the big picture, the overall strength that we're continuing to see, I would argue, in the equity markets. And again, could the argument be made that we're overextended? Yes. And I think that argument, unfortunately, could have been made at most times during 2021. And the thing is, when the market continues to go higher, you have to follow that trend. I think that's what, one of the great lessons learned in 2021 is the power of a bull market phase and the importance of assuming and following trends and remaining in trends that are working when the charts tell you suggest to do so. We talked about sectors and talked about some of the sectors showing relative strength and particularly some of the cyclical sectors potentially starting to reemerge here. Now let's talk about some of the individual names. And I have a lot of screens that I run over the weekend during the week to just make sense of things. And every weekend, I also go through the entire S&P 500 universe chart by chart. And that's a process I've done for a number of years. And it's probably maybe the most helpful thing I do just to understand the equity environment. I encourage you to find time during your weeks to go through a bunch of individual stock charts, even if you don't trade a lot of individual names, because that will tell you what you need to know about the overall conditions, because you'll see the movements reflected on the groups, the leadership themes, and so forth. We're going to start with Riot Blockchain. Now, I'm not entirely certain, to be honest with you, when they report earnings. I think we sort of have a range. It should be sometime in the next week. It may be today. I don't think so, though. So it's at some point in the next week, we'll probably get earnings from them. This is one of the big Bitcoin miners. And, when you talk about the upside potential for cryptocurrencies, when you talk about the overall, growth of this asset class, charts like Coinbase and Riot Blockchain are all of these names that are related to that space that I think provide another opportunity to review how the space is growing, how the industry is evolving, and where the opportunities might be. What strikes me on the chart of Riot is the fact that we've just gotten above resistance here. So Riot rallied pretty high to touch a high just below $80 a share in February. From there, pull back pretty suddenly, and then it's been pretty choppy. And while this looks like a fairly orderly movement, you have to remember this is $80 down to $20. That's a 75% haircut that you're seeing visually there. So this is a volatile space, of course, right? But if you understand that, from there you bounce back up to the 50% retracement using the March 2020 low and the February 2021 high. We hit resistance in June. We hit it again in August, mid-August, and late August. And then again last week. And now just on Friday, rotating above there. And I pulled back today a bit, down about 5%, but overall starting to get above resistance. And so when a chart is able to go from lower lows and stop making lower lows, when it finds resistance and then finally is able to get back above resistance levels, I always find that to be an important pattern to see. So 25 has served as support. 40, we'll call it, has served as resistance a number of times. We've now broken just above there, holding that those levels. The 200-day moving average is currently around 37. I think that would be good to maintaining a bullish thesis on the chart, but overall potentially emerging here to the upside. You do have some stocks reporting this week to highlight. I'll go to advanced auto parts next. When I'm looking at the equity universe, when I was going through the S&P and I got to consumer discretionary, there are a number of pockets within consumer discretionary I think are worth pointing out. Apparel companies that have been fairly rough are starting to rotate higher, things like ROST stores and others. And while they're not great yet, they've stopped going down. And the problem with ROST stores here in early October is it's undercutting moving averages, making lower lows, making lower highs, overall fairly destructive. Now they've rebounded a little bit and testing resistance. And I think that could be an interesting space to see if you see further upside there. But some of the charts in that sector that are already moving higher and continuing to push to the upside are some of the auto parts stores, and it's things like Advanced Auto Parts, AZO, are two stocks within there rotating to new swing highs, continuing to make higher highs and higher lows with impressive retail relative setups. Excuse me. But it's also some of the other parts companies like GPC. What else would be in that space? Like BWA, BorgWarner, interesting one. And BorgWarner might be an interesting one to highlight only because a lot of these, as you can see, are making new highs, sort of going up and to the right. This is a name that's actually pulled back a little bit week from early June to mid-September. From there now has made new swing highs, new swing lows, and testing this resistance here from the last 6 weeks. So potentially, setting up for a nice breakout to the upside, with upside potential certainly to the previous highs, which is another 8 points above current levels, and potentially even further for sure. But overall, that's a space where you're seeing some strong charts and some improving charts. What's also interesting when I think about individual names to highlight is you sort of in the last couple of weeks, you have this long Ford and GM short Tesla trade, which is kind of a funny trade to even suggest, but it's kind of what's happening now with Tesla. You have obviously Elon Musk with the selling shares and the additional supply that creates and all of that. But overall, you're seeing a stock that has had this nice rounded pattern, making a new all-time high into November above 1250, and now bouncing right back down. 1,000 is a big round number, and I can't stress enough, big round numbers tend to be really important on stocks, and you've seen that when Apple or Oracle or one of those hit 1,000 for the first time, it tends to be pretty meaningful. Tesla hit a high around 900 back here on an adjusted basis, broke above it. 1,000 is sort of the lower end of that, the upper end of the gap from mid-October, and that's kind of where we've pulled back to. So holding that 900 to 1,000 level, I would argue, is pretty crucial. That also keeps it right above the 1 trillion market cap, which is an interesting side note as well. But overall, about 25% off of the all-time high just a week and a half ago. Now you compare that chart to the chart of Ford, which is pushing to the upside and not pulling back nearly as much. The same with GM, sort of testing resistance and rotating higher. So, in November, you've seen the traditional automakers rotating to the upside, things like Tesla rotating lower. What else do I want to highlight? I would say also within consumer staples, that's not the ticker STZ, is Constellation brand. Then, boy, we need a wrap. I'm as always looking at the big picture. Consumer staples as a sector is pretty negative from a technical perspective. It's hard to find a lot of things to like in there, but two areas that I think are fairly constructive. Costco is one of those charts that looks like it should be in a different sector because it looks very different than the other ones. And also beverages, particularly alcohol companies, are rotating to the upside. And I think Constellation Brands is maybe a really good example of where that space had been deteriorating through our early mid-September, now rotating higher. So some potential charts rotating to the upside. TAP Molson Coors is another one showing a similar pattern. I like charts that are making higher lows and higher highs after being unable to do so for a series of months. That's all the time we have for shifting stocks. We need to wrap the show. Go to the 3 and 3 charts in 3 minutes. Here we go. Chart number 1 is the Wilshire 5000. And I will ask you a question. How many stocks in the Wilshire 5000? And this is not a who's buried in Grant's tomb kind of question. If you answered 5,000, you're actually incorrect. When this index was launched back in the 1970s, if I remember right, there were actually 5,000 companies. I don't mean remember right that I was alive at that point. I just know my market history, and I know the Wilshire 5000 started as 5,000 stocks representing the broad equity universe. This was meant to be sort of like an everything index, right? And most of us track the S&P or the NASDAQ or even the Dow occasionally, but the Wilshire 5000 is certainly the broadest index that I've seen, besides maybe the NYSE Composite. There are only about 3,500 stocks in the Wilshire 5000. That's one of the interesting themes on how the markets have evolved in recent years and really recent decades, is the fact that there have been just less and less stocks to buy. There are more public companies back there in the 1970s than there are now, because a lot of companies are going private. It's starting to change with SPACs and private companies coming back public, but overall the supply is a lot lower in terms of individual names than it was back in the 1970s. However, the index is making new highs. That was the technical reason for bringing up that chart. Chart number 2 is Masco. I mentioned, industrials and materials seeing strength. When I was looking over the weekend at the S&P stocks, I was pretty impressed with some of the stocks in the industrial sector. MAS comes into mind. This is in a group called Building Materials. JCI, Vulcan, VMC are other charts that look similar to this. These are charts that are rotating higher. And what I like about Masco, it's sort of a cup and handle like pattern where you have a rounded bottoming pattern. You test the previous resistance, a shallower pullback, and you're just resolving that one to the upside today. And I like the relative strength that's making a new 6-month high or so. So I'm encouraged by some of the charts that I'm seeing in the industrial sector. They screened pretty well last week on Wednesday when I ran a screen for my market misbehavior premium members, and I would keep an eye on the industrial sector for sure. Finally, Riot Blockchain, again, coming into earnings this week. I like the fact that it's rotating above the June, August, September highs. The concern with something like this is the extreme volatility. Again, these are career-busting moves on that chart, even though it seems fairly orderly. Folks, that is our show for today. Thank you so much for joining us every weekday after the close for the final bar. As a reminder, all of our previous episodes at StockChartsTV.com. For StockCharts.com, I'm Dave Keller. Have a great night. We'll see you tomorrow.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.